Well, welcome back to Financial Accounting and the purpose of this little mini lecture. I'm joined today by my friend, Mr. Spock, from the original Star Trek. You can Google it. Purpose of this little mini lecture is to go through each of the discussion questions, exercises that we went through in class to make sure that you are clear on these things, the learning objectives associated with them, and that when you see these type of activities again on the exam number 2, you have a successful experience. So let's take a look at the first one. The first one really has to do with our introduction to how it is that we achieve internal control and some of the internal control procedures and concepts that should be in place. Remember, we designed a system of internal control to safeguard the company's assets, to encourage, to produce accurate financial statements, to promote efficiency, and to comply with various federal, state, and local laws. So here's the case that we have here. We've got a guy named Phil who's working for a doctor. He's worked there for a long time. He's thought to be a very loyal employee. In fact, he's so loyal he hasn't taken a vacation in 3 years. He hasn't taken a vacation in 3 years. That ought to set off some little bells and whistles in your head. One of his primary duties at the medical office is to open the mail and list the checks receipts. Okay, that's fine. Someone should do that. He also takes cash from patients at the cash window as patients leave. What's missing here? How do we know that he's accounting for all the cash that he's actually collected? At times, it's so hectic that Phil doesn't bother to give each patient a cash receipt for the payment on accounts. And what about documentation for receipts? That doesn't sound too good there. He assures them he will see to it that they receive their proper credit. When the traffic is slow in the office, Phil offers to help Pam post payments. Well, that's Pam's job to post payments to accounts receivable, not his. However, she's always happy and she's glad he's a conscientious worker. So someone who's got a good reputation as a hard worker. We talked before about the fraud triangle. So if there's a weakness in internal control and there is some external pressure on this guy that he needs money, and he's got some rationale that either no one's going to notice or I'll pay it back, you've got all the ingredients for a fraud. What I had said earlier about fraud is you should assume that if you don't have good internal controls, it's not if fraud will happen, it's when fraud will happen. So some of the weaknesses here, it's Pam's responsibility to post the patient accounts. So if he's helping her do this, then that responsibility, that it's her area, is being violated. Phil opens the mail, receives and records the cash payments, and also appears custody of cash. Well, that doesn't seem like much segregation of duties. Documentation is violated when they're not given cash receipts, the customers, okay? Although many of them don't have cash registers, they do have computerized receipts that they can give to the customers. I get that every time I go to the dentist or the doctor. There's no independent counting of cash, and human resources are definitely being violated here because there's no mention of whether he's bonded, which means it protects the company in the event that he steals. And also they're not required to take vacations. So be prepared. You ought to be able to read a short little case like this, and then you ought to be able to identify, probably in a multiple choice context, what are some of the things that have been violated here in terms of good internal control principles. All right, second exercise had to do with petty cash. So there's basically 3 transactions that we have with regard to petty cash. You got to establish the petty cash fund, then you got to replenish the petty cash fund, and then if you want to increase the petty cash fund. So we've got 3 entries here. So they tell us that we established a fund for $200, and that fund was set up. And then they tell us that it was time to replenish the fund. They counted the cash in the drawer, and there was $59.40. And there was various little vouchers and receipts for these individual ticket items. So first question, briefly describe why a petty cash fund should be replenished. Because there is cash on hand, there's a need to replenish the fund at year end. Okay, so the petty cash fund is there to just take care of little expenses that may occur on a daily basis where you don't want to have to go through all the rigmarole and procedures of getting an invoice and having it authorized for payment and then having someone else write the check. But you got to replenish because there are at the end of the period, if you want to get proper matching of costs and revenues, the vouchers or receipts in that petty cash drawer where you keep the cash represent additional expenses that you have to recognize. So that's the answer to one. Prepare a journal entry to replenish the fund. So we counted the money, and we counted the money in the petty cash fund. We only had $59.40, and these were the vouchers. So first thing we got to do there is to figure out how much cash was reduced. So we know there was $200 in the fund. Just look down here. We know there was $200 in the funds, and we know that there's only $59.40. So when I replenish the fund, I have to replenish it for $140.60. That's what brings it up to $200. Now you take a look at the various receipts. So there was the receipts for freight, for postage, for miscellaneous expense. So you had those three items, but that didn't total $140.60. If you add these up and these up and these up, you add these three, you are $5 short. So that's why we have cash short and over, which is an expense, because there was $5 more missing from the fund than we have receipts for. If there was more cash available than we had receipts for, then it would be a credit to cash short and over. If you have less cash than you're supposed to, it's a debit. So this is how to replenish the fund. So you figure out the expenses, you figure out the credit to cash. Any difference between them is either cash short and over. And then the third one, the office manager wants to increase the petty cash fund by $50. So here we're going to increase the fund. Anytime you either set up the fund or you increase the fund, you debit petty cash and you credit cash. Right? So petty cash is part of cash, but it's not sitting in the checking account. It's sitting in a separate, hopefully secure box or drawer to pay incidental expenses on a daily basis. All right. And the third one here is to do a bank reconciliation. So unlike when we did in class, I went and highlighted two things for you. We call it a reconciliation because we try to reconcile the differences between the balance per our books and the balance per the bank statement. So Sophia, if you were here, I'd ask you, where do we get the balance per the books? And you would say, we get it from the general ledger. And the balance per the bank statement, if I turn to Syed, Syed would say, we get that from the bank statement. That's why we call it balance per the bank statement. So when we start this process, these two things are never going to be equal because there are timing differences. There are things hit the books at a different time than they hit the bank statement. So here's all the information from our books. This was basically what we need to do this problem is what was the cash at the end of the period. So I've highlighted that. So this is all the stuff relative to our books. We deposited this amount of cash. We wrote that amount of checks. Here's the stuff from the bank statement. The bank statement shows $24,635, which is different than mine. And then there were some things that happened here. So there was money that went into my account that I was unaware of. So the bank collected a $4,200 note plus interest. So I didn't know that until I opened the bank statement. And I also earned interest on my checking account of $28. So those are things that actually increased cash that hit the bank statement, but have not yet been recorded on my books. Then the bank giveth, the bank taketh away. The bank also took out of my account a bounced check. Okay, so you're off the hook, Jonathan. This was from J.E. Hoover, bounced the check. So they took that money out of my account. And there was also rent due on the safe deposit box of $75. So they took that out of my account. Also, when I looked at the bank statement, I discovered there was a deposit that I made that had not yet been posted. That's called a deposit in transit. And there were outstanding checks. That means that included in the checks that I actually wrote of $95,500, there was $3,557 of checks that I wrote that did not yet hit the bank statement. So look now, so we got to prepare a bank reconciliation at September 30th. So when you see this on the exam and you see this in real life, always put the name of the company, the fact that it's a bank reconciliation, and the date of the cutoff here, which is September 30th. And you got two starting points. So whether you put this one on top of the other or you put them side by side, whatever works best for you. But you've got to start with the balance per the bank and the balance per the books. And as we said before, they're not going to be equal. So let's do the balance per the bank first. You ask yourself, are there anything that happened on the bank statement, things that went into things that, if I look at the bank statement, is there anything that, any increases to cash that are not reflected on the bank statement? Well, I know when I look at my books, I made some deposits totaling $4,596, and I made them before September 30th. But for whatever reason, the bank's cutoff was different than mine. That deposit doesn't show up on the bank statement. So we add that. And then you got to ask yourself, is there anything missing from the bank statement that would result in cash going out of the account? And yes, there are what we call outstanding checks. So I wrote these checks of 3557. They're reflected in my books in terms of the checks that are written, but they have not yet been paid by the bank. So I subtract them out. This gives me my adjusted bank balance. Now I'm not done. That's what I think the balance should be for based on my per the bank statement, and make some adjustments. Now we take a look at the balance per our books. We look at the bank statement. We say, are there any increases to cash that are not reflected in my books? Well, there were two. The bank collected a note, which I was unaware of, and the bank credited interest on my account. So I have additions to my account not yet reflected in my general ledger account cash of 4,278. And then the bank giveth, the bank taketh away. Is there any money that was taken out of my account that I was not aware of, that hadn't been reflected previously in my cash account in the general ledger? Yes, I had a bounced check of 729, and they charged me rent on the safe deposit box of $75. So now I get my ending cash, adjusted cash balance here, 25,674. I got my adjusted cash balance per the bank here. So here's adjusted per the bank, here's adjusted per the books. These two are now reconciled. And when we say they're reconciled, we mean that we have reconciled our books, our general ledger, to the bank statement. All right. So I hope you found that review useful. And again, I will do these reviews anytime we do stuff in class. So you get to think good and hard about it. You know, grapes suffering on the vine in Tuscany there, you get to think good and hard about it. We quickly go through it in class, and now you can sit back, reflect, and go over it on a more leisurely basis. All right? And if you have questions on this, just post them, please, on our, there's a discussion board open for you on the Brightspace that you can record your questions. Okay, everybody, be well. Have a great weekend. I'm recording this early Friday morning. Take care, folks.